All right, let's dive right in. Today, we are cracking open one of the all-time classics, Benjamin Graham's The Intelligent Investor. And just so we're clear, this book isn't really about picking hot stocks. No, it's about learning how to master the single greatest threat to your financial success, which, as you're about to see, is almost certainly staring back at you in the mirror. So let's start with a kinda provocative question. Is it possible for one of the smartest people who ever lived to be an absolutely terrible investor? The answer is a huge, resounding yes. $3 million. That's the equivalent, in today's money, of what Sir Isaac Newton, yeah, the guy who basically discovered gravity, lost in the stock market. Okay, so here's the story. Back in 1720, Newton had shares in a super hot stock. He did the smart thing. He sold and he doubled his money. But then, you know that feeling, FOMO? It kicked in hard. He saw his friends getting even richer, he got totally swept up in all the hype, and he jumped back in at a way, way higher price. And when that bubble did what bubbles do, it burst. He was completely wiped out. His story is just the perfect example that intelligent investing has very little to do with your IQ. It has everything to do with controlling your emotions. And that really gets to the core message of this whole book. The biggest risk you face isn't a bad stock pick. It's you. It's us. The real job of an intelligent investor is just to build a fortress against their own worst instincts. You know, overconfidence, fear, greed, the whole shebang. So how do we actually do that? Well, Graham's number one most important idea is what he calls the margin of safety. You can think of this as your main line of defense against, well, yourself and a market that can be totally unpredictable. So what exactly is a margin of safety? Well, just think of it as a financial shock absorber. It's a buffer you intentionally build into your investments because you know, for a fact, that you're gonna be wrong sometimes. That cushion is what protects you from those catastrophic losses, and honestly, it's what gives you the best shot at making real money over the long haul. Okay, so how do you build this buffer? Graham gives us 3 really practical steps. First, you've got to avoid market euphoria. Second, you have to choose financially rock-solid companies. And third, you need to diversify. Let's break those down. First up, avoiding euphoria. Now this sounds completely backwards, but you want to be buying when everyone else is freaking out. You want to be skeptical when they're popping champagne. That moment when you feel absolutely amazing about your portfolio, that's probably your point of maximum danger. The best deals, the real opportunities, they show up when you feel sick to your stomach and every bone in your body is screaming at you to sell. All right, step 2 for building that safety net. Only invest in really healthy companies. Graham basically gave us a checklist to find them. He was looking for businesses with big revenues, not a lot of debt, and a long proven history of actually making money. A company that ticks these boxes is just fundamentally sound, which seriously reduces your downside risk. Now, a quick but really important side note here. Graham wrote this book a long time ago. For his price-to-earnings ratio, which is pretty much how much you pay for $1 of a company's profits, he said stick to under 15. But for some of today's massive tech companies, a PE of around 25 can still be totally reasonable. So it's a fantastic rule of thumb, but one you might need to adjust for the modern world. And the third piece of the puzzle is simple: diversification. It's the old saying, right? Don't put all your eggs in one basket. A super simple way to do this is to own a total stock market fund. That's an ETF that holds thousands of stocks, and pair it with a long-term government bond fund. Why? Because historically, these two don't really move in sync. When stocks are having a bad day, bonds often hold their ground or even go up, which helps cushion the blow to your overall portfolio. Okay, so your portfolio now has a margin of safety to protect it from the market. But what about protecting you from you? This brings us to a really brilliant psychological tool that Graham recommends. It's called an investment owner's contract, and the idea is just genius in its simplicity. You physically write down your commitment to your long-term plan before the chaos and panic sets in. It's a contract with your future self, a pre-commitment to not let fear or greed hijack your brain when the market gets crazy. And hey, don't just think about this, actually do it. Type it up, print it out, and sign it with a real pen. Then take a picture of it with your phone. The next time the market is nosediving and you feel that primal urge to just sell everything, force yourself to pull out that picture and read it first. That tiny little pause can literally be the difference between a smart move and a life-altering mistake. Let's move on to the final core idea, and it's probably Graham's most famous analogy of all. He says that to win this game, you have to learn to ignore a very persuasive, but also very unstable character he calls Mr. Market.
So Graham wants you to imagine you have a business partner named Mr. Market, and this guy, he is an emotional wreck. Every single day, he shows up at your door and offers to either buy your shares from you or sell you his. But here's the catch. The prices he quotes are based entirely on his mood. When he's feeling euphoric, his price is through the roof. When he's depressed, he'll practically give his shares away. The intelligent investor doesn't play his game. You do your own homework, you figure out what a business is actually worth, and you only deal with Mr. Market when his crazy moods offer you a fantastic bargain. The rest of the time, you just politely ignore him.
Let me put it another way. If you own a house and you have no plans to sell it anytime soon, would you call a real estate agent every single morning to ask for a new price? Of course not. That would be insane. So why on earth do we do that with our stocks? Unless you need to sell today, the daily price is just noise. It doesn't matter. So let's pull all these threads together. After all this, what does it actually mean to be an intelligent investor? It really boils down to this simple but incredibly powerful playbook. First, you build a margin of safety by going against the crowd, choosing quality companies and diversifying. Second, you create a contract with yourself to keep your own emotions in check. And third, you learn to completely tune out the manic depressive shouting of Mr. Market. And that, right there, is the core lesson from Benjamin Graham. Look, the market is always going to be a roller coaster. That's never going to change. The only real question is, are you going to let its wild swings control your emotions and your financial future, or are you going to be the one in control? The beautiful thing is, according to Graham, that choice is 100% up to you.